on board Sandip Sabharwal to help us make sense of the markets and some of these stocks. Hi Sandip, morning and thanks for joining us. But before we get to the news flow on the stocks, talk about the markets and the sector, give me a sense of what you are penciling in when it comes to the RBI policy, because largely the street is penciling in a 25 bips cut. Do you believe that this is already priced in the market momentum today? And if this is announced, can we expect this to be the leg up that could get markets out of this range, or do you believe that this is factored in and not much can be done about the markets today?
So the markets will come out of a range eventually. I think because we saw significant rallies right from 21,800 to above 25,000 in a very short period of time. So there's a phase of consolidation which is going on, which is natural in the market and which we shouldn't be so bothered about, because only phases of consolidation can help us buy into some stocks which we might like if they correct or consolidate, etc. Otherwise, a straight line market up move benefits no one and eventually leads to big frenzy building up and then markets correcting sharply. Now, on the monetary policy, I think they'll tread the path of 25 basis points only, although there is a significant case for a 50 basis point cut, given the fact that retail inflation could be ranged between 2.75 to 3.25% for the foreseeable future. And as such, even after a 25 basis point cut at 5.75%, Indian real rates will remain among the highest in the world. So I think the real rates need to come down faster. So it's unlikely they'll take this step of 50 basis points, because typically Indian MPC, RBI tend to move conservatively. But if they do, I think it will be a positive development. If not, I think we'll get another cut in August.
All right, but Sandeep, banks vis-a-vis NBFCs, which is looking better to you right now? Because in this rate cut cycle, what we have seen and what is the expectation ahead? Believe that this another rate cut could put some pressure to the NIMs for the banking space, but indeed could be very good for the NBFCs.
So what's happening now that after the rate cycle, cut cycle has started, now for banks, it's coming to a stage where because we have had previous cuts, so we are coming to a stage where bank NIMs will start getting adjusted. So I think although there will be a near-term, short-term impact, but I think longer term it improves the prospects, because lower interest rates lead to better asset quality, and better asset quality is always better than having a 5 basis point extra margin. But you rightly said, and that NBFCs tend to benefit much more in a rate cut cycle, because banks have CASA deposits which have more or less fixed rates, which can vary maybe a little bit here or there. But NBFCs tend to be more bulk borrowers, and they, with a lot of NBFCs having loans which are fixed rate. So a rate cut cycle typically would benefit NBFCs much more. So directionally, some NBFCs, like the high quality ones, could outperform banks. But overall, for banks also, it's not bad at all.
Antique has come out with a note not only on the entire cement space, but playing on this monsoon theme, they've also come out with a note on Blue Star today, wherein they've cut the target price on Blue Star to 1,712 from 1,828 earlier. They say that June is expected to be a washout for this company on the back of early monsoons. Sandeep, what are you making of these notes coming in from Antique this morning? How do you believe that sectors that could be hampered by this early monsoon, like cement and now air conditioning too, could pan out going ahead? Because Antique believes the only trigger here could be the festive season. Otherwise, it looks pretty lackluster for companies belonging to these sectors.
Yeah, for air conditioning companies, obviously, this has been a negative development, because last year growth came back after a very long period of time. And this year there was the expectation of high growth, and as such, many of these companies just stuffed the overall system, distributors, retailers, with huge amount of inventory. Because the initial prediction, if you see, by the IMD was for a very severe summer. And then we had early monsoons, unseasonal rains, etc. So now we are at a scenario where there is huge inventory in the system, and there could be price cuts, etc., to push volumes. And next year's again, the dispatches from companies could get impacted because the system is so overstuffed. So I think it will be a challenging time for this segment at least. And cement also, like the companies tried to increase prices. Obviously, the monsoons made lower demand in the near term, and the valuations of most of the cement companies are very, very high. Given that it's a commodity business, many of the stock, if you see something like Ambuja Cement, it trades at some 60 times earnings. Like it is unbelievable the kind of earnings. So I think we need to see these stocks correct. And once the correction plays out, a normal monsoon would actually mean better longer term demand because as water availability improves. So if many of these stocks actually correct during the monsoons, then it might be a good time to actually look at them at that point of time.
Sandip, I know we were talking about this yesterday as well, and you know how this artificial ban, if you will, from China stopping the supply of rare earth magnets. But the fact that China produces 60% of rare earths and processes 90% of them, the bigger ramification is not just for automobiles, but even for, say, petroleum refining, for chemical processing, electronics, optical glass, clean energy, display screens, wastewater treatment, radiation, steel additives. But do you think the harder hit would be autos clearly?
In the near term, yes, if this issue is not resolved, because most of the companies, so I think two-wheeler companies have indicated less amount of inventory. Some of the four-wheeler companies like M&M, Maruti have indicated they still have inventory for 2 months plus. So, and it's a global thing what they have done. So they have their supply restrictions are impacting companies worldwide, not only in India. So let's see how it gets resolved because ultimately they also need to sell. So they are not selling at all doesn't help them also in any way. So we need to see the how it goes out. So let's say there's a disruption, auto production stalls, then for a month or so, maybe the auto sales or auto production could get impacted significantly. And eventually, I think the supply has to come back. So I think that's the challenge which investors have to evaluate today, that whether there'll be a disruption, if there's a disruption, how long the disruption will be for. So I think near term it creates uncertainty, and now the news flow also has become significant. Most policymakers also are becoming cognizant of this. So let's watch out whether it gets resolved or not. With China, we can never be sure what happens.
That's one sword that keeps hanging on everybody's head as and when China comes out with any new announcement in terms of their trade deals with any trading country in the world.
Deep, you think finally Reliance could perhaps wake up and participate because it's really not in the last leg of the market rebound?
I think last few months, it's obviously outperformed the markets. If we see the returns, which the rally which started from around 1200 levels to the current levels. And I would think that all indicators are there that it should outperform for the next 2 years also, given the fact that it will come out from a huge investment cycle into those investments actually starting to generate returns. And a lot of the subdued parts of the earning growth picture could actually pick up this year and next year. So I would agree with the recent brokerage reports which have been coming out calling for an uptick in earnings and uptick in return ratios, and in turn the stock doing better.
All right, so that's the day coming in on Reliance. But
Sandip, allocate some more to silver in one's portfolio. I know you've always propagated that, gold should also be part of your portfolio. You think silver also should be added now, given the kind of stark divergence between what gold has done and silver, and the fact that silver uptick now seems to be beginning with MCX hitting, or rather silver hitting an all-time high on the MCX just yesterday.
So the story for gold has been more compelling because it's a play on global uncertainties and the monetary policy dysfunctionality, etc. This play on silver is less clearer, but then there always used to be a correlation between gold and silver which broke out, like which broke. Now, if that correlation again is going to play out, and given the fact that silver assets could have been underinvested by a lot of funds and investors, there is a realistic possibility that we could see double-digit gains from the current breakout level, like Kunal said, because it's a multi-year breakout. So typically, if it sustains, so sustenance has to be seen for a few days. But if it sustains, then we could be in for, I think, double-digit returns from here also.
From the current levels, that is something that could happen on silver, but one needs to see whether this uptick is more sustainable and have a little bit more reliable data on that. But Sandip, always good having you on the show. Thank you for your time.
If you like this video, then like, share and subscribe to ET Now.